The euro is in free fall. We're talking about 11 weeks now, if this week plays out as it does appear to be at the moment, which would be the worst run of performance for the euro since its actual creation, and comparable only to the implied euro that one could construct from the national currencies going back to 1997. So are we finally getting to a place where there is maybe some exhaustion? Or is this thing going to continue to sink without a bottom? That's what we're going to talk about here on Macro Money. Welcome. This is Ilya Spivak, head of Global Macro at tastylive. And we're going to try to unpack what's coming up here because we have some important economic data that's immediately on the horizon, both within the next 24 hours and again within the next 48. We're going to focus on the immediate one largely because it'll foreshadow the subsequent and get a sense for, might the euro actually have some legs finally? Could it finally find a floor here? So let's consider the backdrop. Let's consider what we're looking at here and try to get an answer to that question. Here's a chart of the euro. This is the 6E future, and you can see there's a weekly chart here. You can see that persistent decline, just down and down and down. If we were to look at a daily chart, we're also looking at a 7-day losing streak, which is the longest one that we've seen in quite a while, in a few years, as a matter of fact, also. So not only are we seeing this really aggressive decline, but it's actually seeming to speed up. If you look at the current candle here, this one, it's actually much larger, at least for now. Obviously, the week's not closed yet, but it's much larger than what you saw last week, the week before, where the euro was more idle at this former low, this support level going back to just about mid-year, a little bit earlier. But of course, now we find ourselves at the lows for the year. And so naturally, the question comes, well, is this then the place where we could finally see a bit of relief? Have we finally reached some point of at least immediate exhaustion? Well, let's take a look at what has taken us here, how we end up with a euro that's been so low, and we'll try and get an answer to that question and how one might actually go about putting a trade on to reflect it. Needless to say, the economic situation in the Eurozone has looked abysmal. What we see here in the PMI numbers, these are the latest ones for September. Here we can see that the Eurozone economy is shrinking. So as ever, PMI numbers operate on a logic where 50 is the center line, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And so what we see here is manufacturing in Europe has been accelerating lower. In other words, shrinking at an increasingly accelerating rate, basically since the middle of last year. As with many economies, we had a pop in the service sector at the start of this year that crested sometime in the first quarter going into the second, depending on which economy you're looking at. If it's China, it's a little bit earlier. If it's the US or Europe, it's a little bit later. But it's crested everywhere. And so now, in the case of Europe, we've fallen all the way back down into contraction territory, both on services and thereby, of course, on the composite index that includes both manufacturing and services, and is telling us that for 3 months now, 1, 2, and 3, the economy region-wide has been shrinking. That, of course, a potent precursor to confirming a recession. It's not surprising necessarily. This is the latest update from ECB data on lending conditions, at least the inputs for this data. And what we construct here is the Eurozone credit impulse. This is from Bloomberg. They put this together. And essentially what this is telling you works like this. When it's above zero, credit conditions are a positive contributor to economic growth. And the further up you go, the more positive it is. It's a negative contribution below zero, and the further you go there, the more negative it is. So in other words, what we're getting here is a sense of the impact of tightening versus stimulus. And what we see here is at the current setting, this is now the most headwind from policy tightening, from interest rates being high, as it were, in the Eurozone that we've seen going all the way back here to the global financial crisis in 08-09. Here's the Eurozone debt crisis over here. You can see this is actually less dramatic than that. This is more like global meltdown, maybe the end of markets as we know it, or at least a fear of such a thing, kind of credit squeeze. Now, of course, at this time, the ECB was not aggressively raising rates. This was a credit crisis, a global credit crisis. And the detriment to growth from credit conditions is at comparable levels to that. So, not surprisingly, the growth situation looks very much downbeat. The response from markets, of course, has been to mark down expectations for further ECB rate hikes. And indeed, the euro fell sharply after the most recent ECB meeting earlier this month on the 14th, where the ECB hiked rates up to 4%, but then seemed to signal that it's probably done. The rhetoric seemingly suggesting that at least at this point, the ECB isn't going to do much more of anything, and the markets don't really seem to think that more is coming, even with the likes of Christine Lagarde, the president of the ECB, going out there just this week and saying, we're going to hold rates for as high as they need to be to beat inflation and this and that. Markets are dubious about pronouncements like this. Indeed, you can see here, out 6 months from now, we're looking at rates still basically at 4, so standstill. And then a year from now, we're looking at anywhere between 25 to 50 basis points in cuts. So if we had 25 basis points in cuts, we'd be at 3.75. If we had 50 basis points in cuts, we'd be at 3.5. So a year from now, we're looking at something in between that. 2 years from now, we're at 3. So we will have given up 100 basis points, or 1 full percentage point of where we are currently. So the market is modest in its expectations for how much ECB easing is coming, but it nevertheless does think that the ECB is now in wait and see before easing mode, rather than aiming for any more hikes. You can see a palpable shift in this curve lower to suggest that whatever move was expected here to a rate of maybe 4.25 isn't now going to happen, but as far as the markets are concerned. Looking at the makeup of the outlook going out about 1 year forward here, then, we can see that the probability of a rate hike in October, when the ECB next meets, is a very impressive 3.6%. I am, of course, being sarcastic. It is next to nothing. The ECB is not expected to do anything. We have a slightly higher chance that maybe we'll get something before year end, a cumulative 21% chance of a rate hike before year end, because ostensibly the markets are saying if you don't get one here, there's a 17% chance that you'll get one in December, all of which is, of course, very, very low, much weaker than what you would need to have any kind of confidence in this actually occurring. So the markets are very plainly not looking for rate hikes at this point. So with that in mind, we have a transition into cuts. It starts looking more likely than not into the second half of next year. So in June, the probability of a cut is 61%, so a little bit better than 50-50, a little bit more likely. It's all but fully priced in July. So by July, we get one cut. We have a 30% chance of a further cut by September. That, of course, comports with within a year, we get anywhere between 1 to 2 cuts. So a year from now into the future would be late September. And so here we have one cut and 30% chance of another. So again, anywhere between 1 and 2 cuts. This makes for an interesting backdrop. So you might think, well, this surely robs the euro of any chance at life. If the ECB is done, then it's done. But markets don't move that way. They are forward-looking, and so they move on the basis of what is the deviation from expectations in reality. So when reality and expectations clash, that's where you get volatility. That's where you get things starting to actually move. So if we get something that alters this dynamic, then the euro might do one thing or another. And we do have the opportunity for that kind of thing, perhaps with this incoming German consumer price index inflation data, followed the next day by region-wide Eurozone inflation data. The German numbers typically come out a day early and tend to be meaningful stage setting because, of course, Germany is the largest economy in the Eurozone. So when you get the German numbers, you might as well be getting the Eurozone numbers. They very rarely deviate and very rarely have, or at least in the past, have rarely had their own impact, considering Germany will have published numbers earlier and essentially foreshadowed what's going to happen for the main numbers. So German CPI, what are we expecting here? Well, there's a meaningful decline that's expected here from about 6.4 in the prior reading down to 4.5. A very sharp decline in inflation. And much of this seems to be mainly a factor of base effects. The most important part is actually this light blue area, which is the transport component. And the reason it's so important is you can see it was surging here with rising energy prices. This is the shock to gas in particular with the outbreak of the war in Ukraine. So you can see these blue bars getting taller just as the gray bars get taller from this energy shock. And then right around here, you see the blue bars get very small, even as the gray bars remain big. That was a German subsidy aimed at public transportation, essentially telling people, take more public transportation, we'll subsidize the cost, that will also reduce energy use in other places, notably in cars and in petrol. So what that will do is help us to manage this part of it, the surging cost of energy, which, of course, subsequently has been fully squeezed out or almost fully squeezed out. So what we have right here is this really small blue bar here and here. And then in September of last year, this is it right here. This is September of last year. The blue bar gets big again. And that's because the subsidy expires. It was only good for 90 days. That's what we're going to get in this next bar. September data for this year. And of course, it will take as its base in year-on-year calculations that give us the 4.5% change from September last year to September now. That is where we should see a meaningful rebasing, because if we're comparing energy and its impact into transport costs now, both are much lower than they were here. So once the subsidy expires, then you are no longer comparing from here back to these low numbers. You're comparing from here to these high numbers. So the year-on-year transportation component is going to be almost certainly seeing significant disinflation. Because comparing year-on-year from larger numbers to now smaller numbers is a different calculus than from smaller numbers to larger numbers, of course. So the contribution to inflation from the transport sector is going to be smaller. There's also seasonal aspects here. We're just coming out of the summer. So spending on things like recreation, probably lower. Spending on other things like restaurants and hotels, though they're not a big category of spending, probably lower. Recreation, you can see here, is a relatively meaningful piece, actually. That might get squeezed in. So all of this stuff linked to vacationing in Europe might start to get a little bit less inflationary. In fact, food prices have actually emerged as the largest single contributor at this point. You can see they've been easing in terms of their influence. There was a bit of a handoff from large energy price spikes that have since receded as an influence on inflation, and then large food increases that have receded as well. As a matter of fact, if we look at the influence of this, it seems like the UN gauge of world food prices leads the Bloomberg gauge of global CPI by about 7 months. So it seems to take about 7 months for changes in the price of food to filter into overall inflation. And what we see here, unmistakably, it seems, is that there's more runway here for food prices to be leading inflation lower, not higher, because food prices topped and have already been falling for quite a while. And if we delay CPI to match the big swings here, the major inflection points, by 7 months, that seems to imply that there is more runway here for CPI to continue going down, thanks to the food price influence fading. So, naturally, the question comes, well, what does this mean for the euro and what does this mean for the ECB? Well, if inflation is going to weaken, then the ECB is surely getting a little bit of a reprieve as far as more rate hikes. They're basically getting a little opportunity to justify staying pat, to justify not raising rates, even though inflation is well above the 2% objective, and to say, well, look, the economy is in recession. A lot of these factors seem to be deflating. Look, the number is moving lower from 6.4 to 4.5, nearly a 2% decline in the rate of inflation, though it is for base effects. Nevertheless, it is there. And so we are sort of justified then, if we're the ECB, to stay put. But of course, who in the world is expecting anything otherwise? That's exactly what the market is bargaining for. They're saying exactly the same thing. So, if we're going to have an outcome that's anywhere within the realm of expectations, it probably doesn't change anything in the ECB calculus. At the very least, it doesn't make anything worse. Now, maybe we get some kind of a repricing here where inflation surprises on the upside, and that seems to beckon a little bit less of a hurry for the easing cycle. Let's say the cyclical factors, the seasonal factors, the base effects ultimately shake out to be less disinflationary than the market is anticipating. Well, then maybe you don't start rate cuts in July. Maybe you start them in September. That might give the euro a bit of a marginal lift. Let's consider the opposite scenario. Let's say that you calculate all of the base effects and you actually end up with inflation even lower. Well, that might bring cuts forward, and that could indeed weigh on the euro. But what's the probability of that as relative to the alternative? Well, seems like in all of the major elements holding up inflation are indeed heading lower. So the transport component should see disinflationary base effects. Food inflation seems to be coming down and has legs to keep going, apparently. And everything else has been squeezed to a relatively small amount. So the risk that you get much lower than expected inflation seems to be lower than the risk of getting slightly higher than expected inflation. In particular, since energy prices have been on the rise again. So we might get a little bit more life into that housing, water, electricity, and gas component because, of course, crude oil has been surging recently. So it could, in fact, be that we get a slight surprise higher. Now, that, of course, won't change anything for the ECB's hiking likelihood unless the number is so incredibly strong as to shock everybody, but of course to be improbable inherently in the degree to which dramatic outcomes are inherently less likely than something that's closer to baseline. So if we do get some sort of tail risk in a higher CPI direction, that version of the story is probably a little bit more probable than the other way around, than if you get some sort of really dramatic collapse. So it's not likely that you get a big change in terms of immediate policy for the ECB. So in other words, things don't get any worse, but there is a greater likelihood than the alternative that actually maybe you get rate cuts a little bit later because maybe inflation ends up looking a little bit stickier because maybe these base effects are not as pronounced as they're expected to be, and maybe there's a countervailing element from crude oil. So if that were to be the case, then of course that would catch the euro at a very auspicious spot. It's right at support here. If then you get the euro holding its ground here, maybe even get a little bit of a bounce, should that portend trend change? Well, I think the answer seems to be no. Here's why. What we're looking at here is the euro versus the US yield curve. So in other words, we've taken the yield curve outlook for the euro and for the US, and we've subtracted one from the other to give us an implied euro-US dollar relative yield spread perspective. What we see here is that currently the euro is at a 138 basis point or 1.38% yield disadvantage relative to the dollar, and that since the last ECB meeting, that disadvantage has grown, reflecting, of course, subsequent euro weakness, because the ECB appeared to signal that its rate hike regime, if not reversed anytime soon, is in fact done becoming more restrictive, that essentially rate hikes are on indefinite pause at this point. And once the ECB signaled that, the whole curve shifted lower to imply a more dovish view going forward. At the same time, of course, we had a Fed that signaled it's probably done raising rates for now, but that it is going to hold them at relatively high levels for a while. And so we end up with a situation where, with both central banks basically deciding that they're going to sit on their hands for the coming months, we've locked in a dollar yield advantage to the tune of about 1.4 to 1.5% for at least a year. So it's 1.4 here, closer to 1.5 going forward, because the market seemed to think the ECB will be faster to cut. The economic situation certainly seems to explain how that might end up being the case. The U.S. is pointedly not seeing a shrinking economy yet. The Eurozone has been there, as we just saw, for 3 months. So we're in a situation where there's still likely to be, for any kind of forecastable future, going out a year, 2 years, a meaningful yield advantage to owning dollars as relative to the euro. So if we do get a bounce right here, we have some former support turned resistance here under the 108 figure. We might see a correction. We might see digestion, but the trend is unlikely to be broken. Consider what we saw in this up move here. Very spirited advance, but along the way, some pausing, some periods to digest and stall. We've not really had that to any kind of meaningful extent here. I suppose there's one episode maybe here, and then the past two candles before the current weeks is a little bit digestive. The candle here is a little bit digestive, but all of these have been consecutive losses ultimately. We haven't had anything like an attempt at a correction for going on 11 weeks. So if we do get some kind of a pause, if we do find in this data that German CPI has not given the ECB any more reason to duck their own shadow, any more reason to push up when rate cuts are coming, then the euro might be out of immediate reasons to keep falling. And there might be a correction. We might bounce higher, maybe somewhere in the direction of the 108 figure. But that the trend implications of this, as cemented by the locking in of this yield differential very much favoring the dollar relative to the euro, that any gains here are likely to be corrective and a selling opportunity at better, more attractive levels with improved risk reward, rather than anything that presents as a buying opportunity with scope for follow through upward over an extended period of time. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Chris Vecchio, head of Futures and Forex here at Tasty Live, and increasingly Dylan Radigan as well, where we discuss the day's events, the big themes driving markets, and try to make sense of where things are going next. I'm also on with Chris for Futures Power Hour on Friday, on with Tom and Tony for First Call on Sunday, writing for the news and insights section of tastylive.com. As a matter of fact, this very video is summarized in a quick analysis that's up there right now. And then opining on the platform formerly known as Twitter at eur-usd. Thanks very much for joining. Good luck trading out there. See you tomorrow.